Indian Financial System. Chapter 4, Financial Instruments. Part 1. Meaning of financial instrument. A financial instrument is any asset or contract that has money value and can be bought, sold, or traded in a financial market. The word financial means related to money. The word instrument means a tool or document used to get something done. They can represent ownership in a company, a debt someone owes, or a contract that gets its value from something else. Companies use them to raise money, and investors use them to grow their money. For example, when you buy a share of Reliance Industries, that share is a financial instrument. It proves you own a small part of that company. Importance of financial instruments. 1. Facilitate fundraising. They give businesses and governments a way to collect money from the public for projects, expansion, and day-to-day operations. 2. Risk management. Instruments like derivatives and futures help companies protect themselves from sudden changes in prices, interest rates, and currency values. 3. Liquidity. Financial instruments can be quickly converted into cash, so investors can access their money whenever they need it without waiting too long. 4. Encourage savings and investments. They offer a wide variety of options for people to save and invest, whether someone wants high returns or wants to play it safe. 5. Efficient allocation of resources. They channel money from people who have savings to people who need capital, making sure funds are used productively in the economy. 6. Facilitate trade and commerce. Instruments like bills of exchange and letters of credit make it easier and safer to carry out both local and international business transactions. Types of financial instruments. 1. Cash instruments. Their value is directly influenced by the market. They include securities like stocks traded on exchanges and deposits and loans between parties. 2. Derivative instruments. They get their value from an underlying asset like stocks, bonds, or currency. Common examples are forwards, futures, options, and interest rate swaps. 3. Forwards, a contract where two parties agree to exchange assets at a future date at a price decided today. Used to protect against sudden changes in prices. 4. Futures, similar to forwards, but standardized. The exchange happens on a fixed future date at a predetermined price and is usually traded on recognized exchanges. 5. Options, an agreement where the seller gives the buyer the right to buy or sell a certain number of assets at a fixed price for a specific period of time. 6. Foreign exchange instruments, used in the foreign currency market. They include spot agreements, outright forwards, and currency swaps for international transactions. Asset classes of financial instruments. Asset classes are the two broad categories into which all financial instruments are grouped based on what they represent, debt or ownership. Debt-based financial instruments help businesses raise capital through borrowing. Examples include bonds, debentures, and mortgages. The lender earns a fixed return and the company must repay the full amount. Equity-based financial instruments represent legal ownership in a company. Examples include common stock and preference shares. The investor becomes a part owner of the company and does not need to be repaid. Equity shares, meaning. Equity shares, also known as ordinary shares or common shares, represent the ownership capital of a company. The holders of these shares are the real owners of the company. The word equity means ownership or a fair share. The word shares means small equal parts of the company's total capital. Equity shareholders have voting rights in company decisions and receive a share of the profits as dividend. However, dividend is not guaranteed. It depends on how much profit the company earns. Equity capital cannot be taken back by the company during its lifetime. For example, if you buy shares of Tata Motors on the stock exchange, you become a part owner of that company and receive dividend when the company earns profits. Features of equity shares. 1. Ownership rights. Equity shareholders are the actual owners of the company. They have a say in important company decisions and share in the company's success and growth. 2. Voting rights. Shareholders can vote on major matters like electing directors and approving mergers. More shares means more voting power in company decisions. 3. Dividend payment. Shareholders receive a portion of the company's profit as dividend. But this is not fixed. If the company makes no profit, no dividend is paid that year. 4. Residual claim. If the company shuts down, equity shareholders are paid last only after all debts, creditors, and preference shareholders have been fully settled. 5. High risk and return. Equity shares carry more risk than other types, but also give a chance for higher returns through rising share prices and dividends during good times. Characteristics of equity shares. 1. Maturity. Equity shares provide permanent capital to the company and cannot be redeemed during its lifetime. Shareholders can only get their money back when the company is wound up. 2. Claim on income. Equity shareholders have a residual claim on the company's income. They receive dividend only after preference shareholders have already been paid their fixed dividend. 3. Claim on assets. If the company goes into liquidation, equity shareholders get back their investment only after all creditors, debenture holders, and preference shareholders are fully paid. 4. Voting rights. Equity shareholders are the real owners of the company and have voting rights in company meetings, giving them control over how the company is run and managed. 5. Preemptive rights. Whenever a company plans to issue new shares, existing equity shareholders have the first right to buy those new shares before they are offered to the public. 6. Limited liability. The liability of equity shareholders is limited to the face value of shares held. They are not personally responsible for any losses or debts of the company. Advantages of equity shares to company. 1. Permanent capital. Equity shares provide the company with a permanent source of funds. The company does not need to pay back this capital during its entire lifetime. 2. No fixed burden. The company is not obligated to pay dividend every year. Dividend is paid only when there are profits and the board of directors decides to declare it. 3. Creditworthiness. Issuing equity shares does not create any charge on the company's assets, so the company can still use those assets to raise further loans when needed. 4. Risk capital. Equity capital absorbs losses during bad times, allowing the company to continue operations without the pressure of fixed repayment obligations. 5. Flexible dividend policy. The company can retain profits as reserves for future development programs instead of distributing all profits as dividend, giving it financial flexibility. Advantages of equity shares to investors. 1. More income. In boom periods, equity shareholders can earn very high dividends since they receive the residual profits after all fixed commitments of the company are met. 2. Right to control. Equity shareholders have voting rights and can elect competent directors to manage and control the affairs of the company on their behalf. 3. Capital appreciation. The market value of equity shares rises when the company's profits and net worth increase, giving shareholders the benefit of capital gains on their investment. 4. Accessible investment. Equity shares are mostly issued at lower denominations, making them affordable even for people with limited income who want to invest in the stock market. 5. Liquidity. Equity shares can be freely bought and sold on stock exchanges like BSE and NSE, giving investors the flexibility to convert their shares into cash whenever needed. Disadvantages of equity shares to company. 1. Dilution of control. Every time new equity shares are issued, the voting power of existing shareholders gets diluted. Outside groups may gain control by buying a majority of shares. 2. No trading on equity. If a company issues only equity shares and no debt, it cannot use trading on equity to increase earnings per share for shareholders. 3. Overcapitalization. Issuing too many equity shares can lead to overcapitalization, where dividend per share becomes very low and investor confidence in the company drops. 4. Inflexible capital structure. Equity shares cannot be paid back during the company's lifetime, making it very difficult to reduce or restructure the company's capital when needed. 5. High cost. Raising money through equity shares is expensive because underwriting commissions and selling costs are charged at higher rates compared to other sources of finance. 6. Speculation. Equity shares of good companies attract heavy speculation in the stock market, causing frequent price fluctuations that are not in the company's best interest. Disadvantages of equity shares to investors. 1. Uncertain income. Dividend depends entirely on the company's profits and the board's decision. Even when profits exist, the board may choose not to declare a dividend that year. 2. Capital loss in depression. During recessions, company profits fall, dividend rates drop, and the market value of equity shares goes down, causing a direct capital loss for investors. 3. Last priority in liquidation. If the company shuts down, equity shareholders are paid only after every other claim, creditors, debenture holders, and preference shareholders, is fully settled. 4. High risk. Equity shares are subject to market volatility and the company's performance, making them a risky investment with no guarantee of returns or capital safety. 5. Speculation risk. Equity share prices fluctuate frequently due to speculation in the market, which can mislead investors into buying at high prices and suffering losses later. Preference shares, meaning preference shares are shares that have a first priority or preference over other kinds of shares when it comes to receiving dividend and getting capital back if the company is wound up. The word preference means first priority or getting something before others. The word shares means equal parts of the company's total capital. Unlike equity shares, preference shareholders receive a fixed dividend every year. They are also paid before equity shareholders if the company shuts down. However, they generally do not have voting rights in company decisions. For example, if a company earns profit and declares dividend, preference shareholders receive their fixed dividend first. Only the leftover profit is distributed to equity shareholders. Features of preference shares. 1. Fixed dividend. Preference shareholders receive a fixed rate of dividend every year before any dividend is paid to equity shareholders, giving them a predictable income. 2. Priority in claims in dividend distribution and in case of liquidation. Preference shareholders are paid before equity shareholders, but after creditors and debenture holders. 3. No voting rights. Preference shareholders generally do not have voting rights in company decisions. They can only vote in specific situations like when their dividend has not been paid. 4. Cumulative or non-cumulative. In cumulative preference shares, unpaid dividends accumulate and are paid in future years. In non-cumulative shares, unpaid dividends are simply lost. 5. Redeemable or irredeemable. Redeemable preference shares can be bought back by the company after a certain period. Irredeemable shares are not paid back until the company is wound up. 6. Less risky investment. Preference shares carry less risk than equity shares because they offer a fixed return and have priority in claims during both dividend payments and liquidation. Types of preference shares. 1. Cumulative preference shares. If the company cannot pay dividend in a year due to low profits, the unpaid dividend accumulates and is carried forward to be paid in future profitable years. 2. Non-cumulative preference shares. If the company has no profits to declare dividend in a year, the dividend for that year is simply lost and does not carry forward to future years. 3. Participating preference shares. After receiving their fixed dividend, these shareholders also get a share of the remaining surplus profits along with equity shareholders, if the company's articles allow it. 4. Convertible preference shares. Holders of these shares have the right to convert their preference shares into equity shares after a specified period of time, as per the terms of issue. 5. Redeemable preference shares. These shares can be paid back by the company during its lifetime after a fixed period, out of profits or proceeds of a new share issue made for this purpose. 6. Irredeemable preference shares. These shares cannot be paid back during the company's lifetime. The capital is returned to shareholders only at the time of winding up of the company. Advantages of preference shares. 1. Fixed returns. Preference shareholders receive a fixed dividend every year, giving them a steady and predictable income regardless of how much profit the company earns. 2. Priority over equity. In dividend distribution and in case of liquidation, preference shareholders are always paid before equity shareholders, making their investment more secure. 3. Cumulative dividend. For cumulative preference shares, any unpaid dividend accumulates and is carried forward, ensuring shareholders eventually receive all dividends owed to them. 4. Less risky investment. Preference shares are considered safer than equity shares because of their fixed returns and priority in claims during both dividend payments and winding up. 5. No dilution of control. Since preference shareholders do not have voting rights, issuing preference shares does not reduce the voting power or control of existing equity shareholders. 6. Helps in raising capital. Preference shares give companies an alternative way to raise funds without adding to their debt burden, providing flexibility in building the capital structure. Disadvantages of preference shares. 1. Higher cost of capital. Preference dividends are not tax-deductible like interest on debt, making preference shares a more expensive source of capital compared to debentures or bonds. 2. No voting rights. Preference shareholders have no say in company decisions, meaning they have no control over how the company is managed despite having invested their money. 3. Fixed returns only. Unlike equity shares, preference shares do not benefit from a rise in company profits. Shareholders get only the fixed dividend no matter how well the company performs. 4. Risk of non-payment. For non-cumulative preference shares, if the company does not earn enough profits in a year, the dividend for that year is lost and will not be paid later. 5. Less liquid in market. Preference shares are not as easily bought and sold as equity shares in the open market, making it harder for investors to convert them into cash quickly. 6. Reduced returns in inflation. Since the dividend rate is fixed, the real value of returns falls over time as inflation rises, meaning shareholders earn progressively less in real terms every year. That's it for Part 1. Watch Part 2 for debentures, mutual funds, SEBI, IRDAI, and PFRDA. If this helped you, like, share, and subscribe to Riaz Notes.